I'm here with Frank Infurchia, founder of Francis S. Infurchia Company, to talk about audited level financial statements.
Thanks, Frank. Anyway, we've been issuing audited financial statements since we started the business in 1984. Companies issue financial statements so that the interested parties, such as owners, investors, and creditors, can evaluate the results of their operations and their financial condition. And they are supposed to follow a set of rules, which are called Generally Accepted Accounting Principles, so that all financial statements operate under the same rules and investors can qualitatively and comparatively evaluate them. So it's up to us to know what those rules are. That's Generally Accepted Accounting Principles, and if they've been applied fairly to the financial statements. And that's where an audit comes in. The audit is, we're a third party, independent organization that looks at the financial statements, and we want to determine that there are no material misstatements in those financial statements that would mislead a reader of those financial statements. So we have to know about Generally Accepted Accounting Principles: when to accrue an expense, when to accrue a revenue, how to record the cost of an asset, how to record a liability or a contingent liability, and what have you. So we have designed procedures under what they call Generally Accepted Auditing Standards. They're not our standards. I mean, we are guided by the profession's standards. And Generally Accepted Auditing Standards give us a list of procedures and planning requirements that we should employ to make sure that the financial statements are fairly represented. So that's what an audit is. The audit starts with preliminary planning. We look at the financial statements, we look at the general ledger, we compare it to the year before, sometimes we compare it to the industry, and then we look for things that make sense and things that don't make sense. And then we evaluate the company's internal control system so that we can ensure that the company has enough checks and balances in their own accounting department to catch any omissions or errors. And from there, we go through a risk assessment. And a risk assessment is say, well, where are the vulnerable parts of this financial statement that could mislead, if not properly presented, could mislead a reader. And there's a whole format to do that in. And then we look at materiality, and we say, well, what's the tolerable number or quantity that we could possibly get wrong and still not mislead the reader? So this is all preliminary stuff. And then from there, and then we use that preliminary information, right, to the internal control, the assessment of risk, and what have you. We use that to determine what we're going to test, what accounts we're going to test, and how much we're going to test of each account. So if you have a strong internal control system, if you have low risk, then we don't necessarily our samples don't have to necessarily be as high, right? If we think that that's a small company and there's not a whole lot of internal control, we'll probably end up testing transactions more so. What is a test of transactions? I can list a few. Cash would be, we'll look at cash. Do you really say, you said you had $100 in the bank, do you really have $100 in the bank? We'll look at the bank statement. We'll look at the outstanding checks to see what cleared in the next month, or the deposits in transit. You say you have $500 in receivables from customers. We'll send out a confirmation to the customer. And if the customer doesn't respond, we'll look at the invoice that supports that $500, and we'll look for a subsequent payment after the year end to see, we gather evidence. Similarly, with equipment purchases, we'll look at the invoices that they purchased the equipment for, and we'll look at how they properly depreciating the asset. It's going to last 5 years, 10 years. We get to write that equipment off over a period of time. So we want to make sure that our depreciation schedule is correct. When we look at receivables, we want to make sure that the customer says, I'm owed $500, can we collect it? We have to make sure that there's no need for a bad debt provision. We look at accounts payable. We look at the vendor invoices. We'll look at subsequent payments. We'll look at billings. We'll look at shipping orders. We'll look at invoices, freight documents, what have you. Similarly with expenses, we'll look at the vendor invoices. Did it go through a proper course of management approvals that it was paid for? And then we step back after we've gone through all the individual transactions and looked at various things like payroll and inventory and what have you. And we'll do ratio analysis. We'll do analytical procedures. Do payroll taxes, there should be a certain ratio of payroll taxes to payroll. Does it come out? There should be a certain relationship of depreciation to amount of assets that you've acquired, right? There should be an industry standard more or less of how many times the receivables turn over, how many times the inventory turns over. And when we compare to the industry, if those turnovers are either high or low compared to the industry, we know that possibly year-end inventory or year-end receivables are not properly stated. Okay, because that will it'll kind of cull out, a possible error. So we'll stand back, do analytical procedures. We'll compare to the previous year, and we'll compare to the industry. And we obviously do a lot of management inquiries, and we have a lot of discussions during the audit with the controller and with the company, and so that I think we get just a whole envelope of information, and then we issue kind of like a preliminary financial statement with the note disclosures. So the financial statement is the balance sheet, the income statement, the statement of cash flows, and all these note disclosures that explain everything that's not just apparent on the financial statement. And then the audit committee will look at it and they'll say, yeah, that's not right, this is good, can we say this? And then we'll assess that and we'll issue a final document. We have to, so that's what an audit is. I mean, there's representation letters, we look at budgets, we look at minutes, we look at everything. But we eventually get to a point where we think, as independent auditors, we're comfortable with issuing the financial statements, and that the reader is assured that, we think that the financial statements are fairly presented. So that's what an audit is. But, we do different kinds of audits. We do normal for-profit audits, and we do nonprofit audits, which are their own little specialty, and then we do forensic audits. Nonprofit audits include everything we just discussed, okay? But they have a slightly different format of financial statements because readers want to know how much of your expenses, not just the general ledger classification of expenses like advertising, insurance, payroll, what have you, that did you incur, but how much was devoted to the program? How much was devoted to fundraising? How much was devoted to management in general? Those kind of things. And because normally the chief readers of a nonprofit financial statement are the donors. They want to make sure that their funds are being efficiently employed, or deployed, I should say. And so we have a statement of functional expenses, right? And we have disclosures. And we find in nonprofit audits that there's a lot of oversight. There's not just one owner or a small group of owners that are looking at the financials. There's a board that meets monthly, and they get reports. So we're kind of comfortable with nonprofits because there is so much oversight. They have budgets. They have copious minutes meetings that they have minutes for that when we read them, we say, we didn't know about this, we didn't know about that. So there's just a lot of independent third-party types evidence that we can rely on. And then, of course, we have to use fund accounting and we have to use the functional expenses. So that's a slightly different layer.
If you have any questions about our auditing process or if an audit is right for you, please feel free to give us a call and we'd be happy to talk to you.